Spotlight.
This is Akashvani. In the program Spotlight, now we bring you a discussion on RBI's bi-monthly monetary policy. The participants are A.K. Bhattacharya, economic analyst, and Arjun J. Chaudhary, anchor.
I'm joined by Shri A.K. Bhattacharya, whom we fondly call AKB. And today's topic of discussion is on the central bank. RBI's bi-monthly monetary policy announced by the RBI governor, Sanjay Malhotra. AKB, it's good to have you on the program.
Thank you, Arjun, for having me here.
So the big news is the repo rate has been cut by 25 basis points. Before the cut, it was 5.5% and now it's 5.25%. The Monetary Policy Committee of 6 members have had a unanimous vote making this decision of a 25 basis point cut, and they've cited some reasons why they have cut the repo rate by 25 basis points. Let's now hear what RBI Governor Sanjay Malhotra had to say.
The MPC met on the 3rd, 4th and 5th of December to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points and the RBI.
So for the benefit of our listeners, could you tell me what they are?
What they are looking at for the next few months is a scenario in which inflation will continue to remain benign, growth prospects remain undimmed, and the external sector uncertainties are by and large are not that volatile to cause any extra ripples in the pace of economic growth, downward ripples. So therefore, based on all these assessments, the Monetary Policy Committee members unanimously decided to cut the repo rate by 25 basis points. Remember that this calendar year, you have seen interest rate cut of 125 basis points. So it's almost 1.25 percentage point cut in the cost of money from 6.5 to 5.25. That's quite a lot in 1 year. More importantly, the inflation projection shows that it will not, from next year, it will not be more than 4%. Now, as you know that the inflation target under the flexible target regime is 4%. And what the governor pointed out is that the second quarter numbers for inflation, retail inflation, is for the first time since the flexible inflation targeting regime kicked in November 2016. For the first time, a quarter has seen a retail inflation level which is less than the lower margin of the regime, which is 2%. It is 1.7%. So I think buoyed by the inflation scenario as well as by the fact that growth is doing well, 8.2% growth in the second quarter, and the projection for the full year's growth has been increased, revised upwards to 7.3%. Based on these both inflation downward and growth uptick, the Monetary Policy Committee decided to cut it further.
It's very interesting that the inflation forecast earlier was 2.6% and now it's 2%. And GDP, gross domestic product, is at 7.3% from the earlier estimate of 6.8%. What has led to these revised estimates and forecasts? Clearly, if you look at nominal GDP, it's affected by inflation. You have to adjust it to get the real GDP as well. But how is it that inflation has remained under control? Is it just through monetary policy mechanisms or because of supply side economics? Is there a economic equilibrium of demand meeting supply and supply meeting demand?
Not really. What has happened is that the availability of food items in the system has been very good. Agricultural output has been good. The monsoons have been favorable. Therefore, the food prices, particularly, which has the food and beverages account for almost 40% in the retail price index, they remain depressed. Naturally, the overall retail index, price index, actually remains depressed also. So I think that is what has given a big boost to the Monetary Policy Committee's desire to remember that even though the prices have come down, even though growth is seeing an uptick, fact of the matter is that the Reserve Bank of India's Monetary Policy Committee has also decided to inject about 1 lakh crore of extra liquidity into the system. Which means what? Which means that the RBI is not just content by just reducing the interest rate cost of money, but it is also feels that it must supplement the money market, money system, monetary system with extra infusion of liquidity so that money is available cheaply. So 1 lakh crore of extra money, and if you include the $5 billion currency swap that has also been announced by the RBI's Monetary Policy Committee today, you will see actually probably around 1.4 lakh crore of extra money coming to the system in this month alone. All in all, what the RBI has done is that given the fact that inflation is benign, given the fact that growth is buoyant, monsoons have done well, kharif crop output has been good, and next year's inflation forecast, which was earlier little higher, has been brought down. So riding on that, the RBI's Monetary Policy Committee thought that let me reduce the interest rate and along with that inject more liquidity into the system so that money is not a cause for concern in boosting economic output. Also remember that the capacity utilization levels in the economy has seen an increase. So there are early signs where investment from the private sector is going up. So taken together with the government investment and the private investment, probably Reserve Bank of India's Monetary Policy Committee thinks that you need to reduce the cost of money. And one of the members, remember, has actually dissented from the views of other Monetary Policy Committee members. There are 6 members. So 5 of them said that the stance of the monetary policy should remain unchanged at neutral, which means that neither moving this side or that side. So no signal to the market. But one of the members has said that it should have been accommodating, which means that considerable debate and discussion that must have taken place in the Monetary Policy Committee meeting for 3 days, details of which we'll come to know only on 19th of next month or so. All I'm saying is this, that this was a committee meeting that discussed the inflation potential, discussed growth potential, and discussed the need for increasing money supply into the economy and making the cost of money a little more cheap.
So are we likely to see an uptick in credit growth at the retail level?
I do not know about retail level, but already the credit supply in the system, the bank credit has grown by around 13%, if I'm not mistaken. And I think the intention of this policy is also to make credit cheaper so that the industrial enterprises, trade, individuals do not move their money out of the banking system and borrow money from the non-banking system. So if the money is cheaper, then probably more people will come and use. Another additional impact of this policy would be that for those who are on a flexible interest rate on their housing loan, their benefits will be significant, because if you have seen in this calendar year, as I said in the beginning, the interest rates have actually come down. The repo rate has come down by 125 basis points in 1 year, 1 calendar year. Then I would imagine that the benefits to those who had taken housing loan, and a large number of people in India do take housing loans at a flexible rate of interest, they will benefit, which means they will have more disposable income with them. And hopefully, that's what probably the RBI and the government will think, that they will go into the market and buy more goods and products and more services, so which will create a kind of a virtuous cycle in the economy.
Let's now hear what RBI Governor Sanjay Malhotra had to say on the conduct of Open Market Operations OMO for the purchase of GSEC government securities to the tune of 1 lakh crore rupees and a 3-year dollar-rupee buy-sell swap of $5 billion this month in December to inject further durable liquidity into the system.
Moreover, in view of the evolving liquidity conditions and the outlook, the Reserve Bank has decided to conduct OMO purchases of government securities of 1 lakh crore rupees and a 3-year dollar-rupee buy-sell swap of $5 billion this month in December to inject further durable liquidity into the system.
AKB, the open market operations being conducted by the central bank, the liquidity infusion of 1 lakh crore rupees, who's buying the government treasuries right now?
Well, right now you have got a lot of the economic participants like banks, traders, they can actually enter the market. It will essentially mean that more money is available in the system which can be tapped by banks, NBFCs, other entities.
$5 billion in the form of foreign exchange swaps. What's the purpose? Is it to stabilize the rupee against the dollar? And one of the bases for justifying the 25 basis point cut in the repo rate by the Monetary Policy Committee of 6 members is that the rupee has faced a 5% depreciation against the US dollar. That's resulted in a 35 basis point fall in the consumer price index and a 25 basis point rise in net profits. In simpler terms, what does this mean?
Well, what it means is that the interest rate differential in India and interest rates in external currencies is actually widened. So, which is why the currency swap idea has been mooted. You will remember in 2008, the Fed had introduced a similar currency swap mechanism, which many banks, including some central banks in the developing countries, had taken advantage of. Something similar has been sought to be achieved in this move, by which you hedge your current exposure in a certain currency by way of interest payment. You hedge that against in an interest payment liability in another currency, which probably would be higher or lower than what your liabilities are. So it's a complicated accounting exercise, but at the end of the day, if you use those instruments carefully and efficiently, you tend to hedge and improve the total money that is available into the system substantially.
So apart from the forecast and the estimates of inflation, which is stated to be 2% for the financial year 2026, and GDP is at 7.3% growth, there have been figures on foreign direct investment and net exports as well, targeting the services exports. Foreign direct investments, let's begin with that. April to the September 2025 period, we've seen a rise of 19.4% to $51.8 billion. This is against $43.4 billion in the same period last year. Foreign direct investment, how important is that for the growth of the economy? We know that it is used for computing gross domestic product as well. And how important is it to match the forecasts of the RBI in terms of our GDP of 7.3%?
Well, it is important for keeping the wheels of the Indian economy going. Foreign direct investments, figures that you gave are of gross foreign direct investments. And right now, our external sector is fairly strong. External sector whose spirit is captured through the current account balance, which is the deficit is declining because we are getting more money through these gross foreign direct investments as well as remittances. So our external sector is quite stable right now. But on the gross foreign direct investments, what I would say is this, that what we are seeing is that while gross foreign direct investments still are growing, but there's a trend that we are seeing wherein a lot of existing investors, foreign investors, are taking their money out, and a lot of Indian investors here are investing abroad. Now, this, you can look at it in two ways. One is that in an economy where entry and exit both are easy, it is a flexibility and it is a positive. But at the same time, it needs to be asked that why is it that Indian entities are going out more than investing in this country? So the gross foreign direct investment numbers will tell us both these stories, and it will require a lot of policy reforms and policy challenges as well to make sure that the gap between the gross foreign direct investment and net foreign direct investment, they reduce so that more money is retained in the country, which is used for boosting growth and sustaining economic activities.
Thank you, A.K. Bhattacharya, for being with us on Akashvani and talking to us in detail the central bank RBI's bi-monthly monetary policy, which was announced by the RBI Governor, Sanjay Malhotra.
Thank you very much for having me.
You were listening to a discussion on RBI's bi-monthly monetary policy. The participants were A.K. Bhattacharya, economic analyst, and Arjun J. Chaudhary, anchor. This program was produced and presented by the News Services Division of Akashvani.
Spotlight.